Thank you very much. Good morning to all of you. First of all, thank you for the invitation to speak at this event, which I very much appreciate. And I would then briefly also introduce myself. I work for the European Banking Authority, where I covered over the last 7 years a number of roles, including development of European SREP. But for 2.5 years, last 2.5 years, I'm leading the team, which is dealing with two main topics. It's innovation and then topic of the capital market union, including sustainable finance. So today I'm here to speak about what is it that the Europe is doing on sustainable finance, where we are at the moment, and what you can expect as implication for financial sector. And I would, of course, coming from the banking authorities, say a few words also on what are the implications for banks and where we are with the work at the moment. So we can start with saying, and I'm not speaking for European Commission, if we go to the first slide, that, of course, this agenda is very much led by the European Commission, which already in 2018 published its action plan on sustainable finance. And yes, while you can see this, there is a political agenda. I will also try to explain to you that there is also risks in the financial sector, and we as prudential supervisor like to speak more about those risks rather than some political objectives. But I have to start from speaking about the lead by European Commission. So in the first phase of the sustainable finance agenda, they were trying to take actions to address these key challenges, which I'm covering here. So there was no common definition on sustainable finance. So we needed a common EU taxonomy. There is, of course, risk of greenwashing of investment products. So for that, there is a lot of work going on labels and for green financial products, and then also to set new rules for climate and environmental risk for issuers and advisors. And then also the next point was there was too little information on corporate sustainability and related activities. So all of this has been addressed through number of legislative proposals, which by now are approved. And the main ones are on EU classification system, on taxonomy, on new disclosure requirements, new sustainability benchmarks, and the EU green bond standard. All of this work was very much supported by the technical expert group on sustainable finance, with a lot of experts from different industries and fields supporting Commission on technical criteria. And this package is more or less finalized, and now is going to be implemented into more direct or is going to be implemented via legislative rules. Of course, speaking for the European supervisory authorities, we got a number of mandates from this first phase of work on which we are working now. And we can go to the next slide. So this is what has been already going on. And now I would like to say a few words about what you can expect going forward. So if we can move to the next slide, thank you. First of all, commitment on greening the financial system and moving into more sustainable economy and society is the commitment of all co-legislators in the EU. I'm just listing here that, of course, all of you, I'm sure, heard about the Green Deal as a big announcement of the new Commission. Then also, European Commission proposed the European climate law. Parliament stated climate emergency, and also European Council with heads of governments endorsed the objective of achieving a climate neutral EU by 2050. So you can see the commitment is there from all sides of the legislative bodies in the EU. So there is a strong push, strong political agenda there, but also, as you can see, there are slightly changing societal expectation, and people are also slowly moving to think more and more. So there are changes and pressures from all sides. So what the Commission is preparing now is to publish a new renewed sustainable finance strategy, which will set the objectives and tasks for the upcoming years. And what might be the most relevant for you to mention is that there is ongoing review of the non-financial reporting directive, which is key for getting better environmental information on companies, which also financial sector is financing. And very importantly, the new taxonomy is being implemented via legal framework, so will be legally applicable for financial market participants. And then on the side of ESAS, we are working intensively on technical standards. Now I would like to move into answering the question, is climate change also a source of financial risk? And let's forget a little bit about the political agenda. So if we can move on the next slide. So maybe many of you already heard about a group of supervisors and central banks called Network for Greening Financial System. And this is a voluntary group set up by two main authorities, Banque de France and then Dutch Central Bank, and currently has over 40 members across the globe. And this group of supervisors and central banks understood the importance of climate risk and climate change, and decided that it's time to speak about the impact on financial sector, because climate change is also seen as a source of financial risk. So without any political agenda, supervisors and central banks across the globe got together and decided that maybe we should really take this seriously also from the financial side. So if we can go to the next slide. So what is NGFS saying? And I can only speak about it very briefly, and you can read much more if you go on their website. So all these supervisors, and it's not only European, I'm stressing that, they see the climate change as a source of structural change. And that's why from the financial stability and prudential risk perspective, they see the need for central banks and supervisors to pay attention to the climate change, because they see it as a source of financial risk. And within that definition, it falls under the existing mandate of central banks and supervisors. Why? Because the structural change, given the scientific evidence and expectations, the structural change means that if those scenarios might eventually happen, the impact will be far-reaching in breadth and magnitude. There will be a foreseeable, it's a foreseeable nature of these events. They might be irreversible, and they very much, the mitigation very much depends on short-term action, to acting soon rather than late. And also the expecting impact is expected not to act the way as we are normally used to in finance. So it will be not a linear impact, and that's why all this attention is also paid by supervisors to climate risk as a source of financial risk. Now I will move into what is the European Banking Authority doing in this context, and what mandates do we have, if we can go to the next slide. So I gave you the EU view, then the bit of global view, and now let's go straight into the regulation of banking sector, where I'm directly involved. So of course we are working within the legal mandate which we have, but we already published last year as the EBA action plan on sustainable finance, which is outlining the roadmap, but also already stressing several policy messages to the banking sector, telling them mostly not to wait until we will finish all the policy and implementation work, but stressing the need to already act now proactively on the ESG risk management, especially on the side of business strategies, because a proactive approach to to ESG, to environmental and social issues, is seen as a mitigant of future impacts of these risks. So that we are really encouraging banks to set targets, think about how green or how brown they want to be. We are not telling the sector that they should all go to green. We are telling them to look on ESG and set up the targets and strategies which are long-term and decide what type of institution I want to be. And then adjust their business processes and strategies and products to that strategy, and then be transparent about it. Also, gradually implement methods to evaluate the risk in the risk management framework, especially with focus on scenario analysis as an important tool to estimate potential impacts. And then we are really strongly advocating for disclosures also on the side of banks. So if you go to the next slide, and these slides will be shared with you so you can look on that. So we have these specific mandates, and I cannot speak about all of them, but briefly saying we will be introducing concepts and rules eventually for incorporating environmental and social factors into Pillar 1, Pillar 2, and Pillar 3. So in all of these parts of the prudential framework. So with priority on Pillar 3 and Pillar 2. So Pillar 3 means that still in next few months we will publish a draft technical standard for consultation on disclosure for banks on ESG disclosures. And as you probably already know, there is already published for consultation joint committee technical standards on investor and consumer disclosures, which is applicable to all financial sector horizontally. So this disclosure is very important, and it's key for really maybe pushing the sector the right direction and taking responsibility. And then the second in the order for the EBA is the mandate on how to incorporate ESG into risk management of banks, investment firms, and supervision. And only later we will be looking on prudential framework, how to reflect sustainability in potential adjustments of prudential rules. So that's still, the deadline for that is later, so that's why we are also looking in this order, but also there is a big issue with data to deliver more on the prudential framework. So I can give you, if we go to the next slide, I can give you a brief overview, because this is coming very soon from our side, that we will be publishing a discussion paper on how to incorporate ESG into risk management and supervision of banks and investment firms. So with this discussion paper, of course, we will be seeking input from financial sector, but at the same time already setting the clear direction for the banking sector on what we expect them to implement. So with this discussion paper, we will introduce a number of common definitions which are key for evaluation and comparability between different banks and investment firms. Then we will also elaborate a lot on metrics and tools and methods to evaluate ESG risks. And these are the foundation for then what we are building later. So what ESG risk management expectations and supervision of ESG risks. For each of these areas, we will be introducing recommendations, which then later will be translated into guidelines and technical standards and will become binding rules. So please pay attention to this publication, and we hope that also from Denmark we can get good input into our work, because this is a discussion paper, but it's a big and important piece of work for the financial sector. If we go to the next slide, then this is just for reference for you, that those mandates which I showed before, they will be delivered within the next 5 years. And just to demonstrate that there is still a lot of work to do on our side, and you can find this roadmap also on our website. I would now spend a couple of minutes on the next slide with what's coming, what else is coming again from the European Commission agenda. Maybe many of you noticed that the Commission was consulting on renewed sustainable finance strategy over the summer. And I'm outlining a number of areas on which they were consulting. So it's likely that you might expect, I'm not saying that all of this is happening, but you might expect additional changes for the phase 2 of Commission's agenda, that additional rules will be adjusted to move into more practical implementation of sustainability in financial sector. So under this consultation, Commission is considering if changes in reporting, transparency and accounting rules need additional adjustment. Of course, they are paying a lot of attention to the topic of data and potential involvement of Commission in developing tools for access and database which would be as a public good for financial market participants. Further work on standards and labels can be expected. Then also on corporate governance and topic of long-termism and investor engagement. Important part is dedicated to green securitization, which is seen as a new potential type of instrument supporting shift to the goals of sustainability. But Commission is also looking on what are the right incentives to set up the rules for financial sector that they would be really incentivized to greening. A discussion on if we need also brown taxonomy in addition to the green one, and then further adjustments in prudential rules for each part of the financial sector, so insurance, banking, asset management, pension providers, and changes for credit rating agencies. As you can see, this is a quite broad range on which Commission was consulting, and as I said, that we can expect still their proposal before the end of this year on a renewed sustainable finance strategy package, which will then introduce which specific changes will be dealt with in the second phase of Commission's work on sustainable finance. So I would stop here, and I am happy to answer questions you might have. This was just like a little bit of insight into what's going on, and I could speak for others, but I hope that it gave you a good overview.
Thank you very much. Now, before we turn to the questions received online, is there any questions here among the audience? There's a question. We have a micro somewhere down in the corner.
Thank you for the very good presentation. I think one of the things that I really like that you point out is that financial risks are fundamental and key. And I know we're still working in this to quantify those in a good way. What are the current views in the central banking network around capital adequacy and whether the capital situations in the banks are sufficient to meet some of the challenges? And how do you see that, particularly whether institutions choose brown versus green business models?
Yeah, so thank you. Can I go directly into answering? Yeah. So no, this is a very good question, because of course, if we start looking on green and brown as a source of financial risk, of course, on one side there is a teaser that maybe green is less risky, but even that, of course, needs to be proved. But also on that, we have to look on the other side that brown probably means higher losses eventually. So, of course, then the discussion about the capital starts here. So, is the current framework calibrated well for thinking about color of your assets as additional element in calibration of prudential framework? This is a very sensitive topic, and that's why I said that from our side, the work on prudential framework comes, it will need a bit longer time, because we are technical agency, and we would like to take an approach which is evidence-based and risk-based. So that we would like to look on data which are available, and also using some forward-looking aspects and predictions on developments on green and brown side before we propose any solution. I think your question was going more into, are the banks able to cover this potential differentiation between green and brown with the capital? I think that's a question on which I do not have an answer today before we see the impact and potential calibration. What I'm trying to say as the main is that this should be the risk-based framework should be kept. And from prudential side, we have no political objectives to move banks certain direction, but we need to be sure that the risks are covered. So all these questions will have to be answered as we go down the road, and I'm sure there will be technical input which is coming from our side, and I'm sure this will be subject to strong political discussions on the final framework which then can be implemented in practice. But from the risk perspective, yes, we can expect that some differentiation might come as an outcome of this analysis, but we are not there yet that I can tell you now that it's clear. NGFS have done some preliminary work on this, but their conclusion was that there is very limited evidence to make any conclusions on risk differential between green and brown.
Very interesting. Is there any more questions? No, then we have a few questions received online. When will the discussion paper on ESG risk management be published?
So you can still expect it in 2020. And I don't want to tell you the exact month. Of course, it's going through the steps in the governance process, but it's hopefully in the upcoming 6-8 weeks, I hope. So somewhere there, but still 2020.
And then we have one more question. At present, there is an understanding that lending is not such a big issue from a compliance perspective. And do you think that that this will continue? Otherwise, bank will start to be a bit restricted in terms of lending, which might damage the economy?
Yes, so I guess this question comes from that currently lending is excluded from the taxonomy, and that disclosure under the taxonomy is not linked with banks' portfolios. Yes, that's true, but in our disclosure work, we are very much interested to introduce what we call preliminary green asset ratio, and make it transparent on bank side to disclose the targets which they have for their own portfolios, long-term targets on how green or brown their portfolios should be, and then where they are on the path meeting those targets. So, of course, if you introduce ESG into your risk management, then you have to decide what bank you want to be. We are not going to prescribe that you need to be a color green or light green or dark green or brown. We are just going to expect banks to set up clear strategies, disclose those strategies, and then let investors and clients to decide, on which bank they want to engage with. But at the same time, I'm not excluding that some banks may, of course, implement some exclusion strategies. But this is not what we are guiding them to do. This is more, if it happens, it will be the impact of their analysis of what bank they want to be long-term based on the risk profile and the risk they are able to bear going forward. So, of course, what I should maybe stress is that very important element in our discussion paper is that we are introducing 4 main elements which we expect banks to work when it comes to reshaping their business strategies and business models to incorporate sustainability. And one of those 4 is proactively working with your clients on their transition path, to start thinking about how banks can finance transition of clients they finance rather than excluding them. So this is the way we are thinking about this. So not to start financing, but maybe to think how you can support the clients, how to be more on the side of advisor to transition of your clients rather than excluding them as one way forward.
Thank you. I think maybe we have time for one more question, right? Or yeah, all right. So some financial institutions are front-running this sustainable transformation agenda, where others are taking a more conservative approach. So we were thinking, or maybe asking the question of how do the EBA strike a proper balance between monitoring these two sets of institutions?
Yeah, so again, we, from the prudential regulation perspective, and the supervisory perspective, we as regulators, we are not prescribing business models of banks. We are evaluating and regulating risks and be sure that those risks are covered. So I think I already elaborated quite a lot on thinking of the EBA, especially on this side of a bit pushing on transparency and changes in business strategies as a proactive tool to mitigate the risk. But then there is also the supervisory leg. And here I would say that you probably are all aware of, maybe not, because of Denmark is not in the Eurozone, so maybe not, but the ECB is very active in their involvement in climate risk, and they published consultation paper with supervisory expectations on climate risk, but I'm also sure your Danish supervisors are equally active. So these conversations with supervisors on really what risk is there and what does it mean for the long-term resilience of bank are coming, and they are happening. So I think those conversations will create some movement of thinking which direction to go and how proactive I want to be. And this is actually one of the elements which we are proposing in this discussion paper, that supervisors should introduce a new element or new part of their supervisory assessment, which is called for now long-term resilience of institutions, which is not going to be capitalized, that's not the point, which is going to be the input into the conversations on business model and on direction. And within this new element, it should help to guide the management of institutions to consider the direction and then again decide which direction they want to go. And eventually, when we also look on the risks later, then of course the risk differentiation will show us how ready banks are to cover risks related to the structure of their balance sheet, including sustainability elements.
Super. Thank you very, very much for a very interesting presentation. Yeah.